GM, good morning. Welcome to the Milk Road Show, the daily crypto show where our crypto insights are as sharp as the pencils on the first day of school. I'm your host, Jay Hamilton, and today we're joined by expert investor Lark Davis. In today's episode, we'll discuss what events and key dates will have the biggest impact on markets in September. Global money supply just hit a new all-time high. What does that mean? And will the U.S. economy get the soft landing everyone is talking about? Before we jump into today's episode, we just need to take a minute to hear from our awesome sponsors over at Gemini and Kelp DAO.
Discover Gemini, the US-based exchange built for new and advanced traders. As a special welcome gift, they are offering new customers $15 in Bitcoin just for trading. At Gemini, security is a top priority. As a licensed full reserve exchange and custodian, your assets are well protected. Plus, they offer cutting-edge security features like passkeys to keep your account safe. This exchange is setting the standard for compliance and innovation so you can trade with confidence. Head over to gemini.com/Milk Road and start trading today to earn your $15 in BTC. Sign up now and get ready to join the trading fun.
Get ready because your reward farming game is about to level up. Introducing Gain, powered by Kelp, your DGen concierge. Gain is an automated vault launched by Kelp that maximizes rewards for ETH users. It offers one-click access to airdrops and points from leading L2s like Linea, Scroll, Karak, and more. Here's how it works. Head over to milkroad.com/Kelp Gain and spot airdrop Gain. Get a complete overview of how your assets are deployed and the rewards and points you stand to gain. With just a few clicks, deposit ETH or SETH or liquid staking tokens into the smart vault. That's it. The best part, once you deposit, you're issued a liquid token, AGETH, enabling you to participate in DeFi on Pendle, Spectra, Lyra, Splice, and others. Gain is already live and you can go check it out for yourself today. Just head over to milkroad.com/Kelp Gain and get started. Lark, welcome back to the show. September is a big month in the calendar right now. Everyone's a little bit scared after a summer of chop, and everyone wants to know, when does number go up again? When is it finally going to start? Can you walk us through? I don't expect you to tell us when it's going to start, but there is some big items in the calendar this month, from unemployment data, which actually came out last week, which we'll touch on quickly, and a few other dates. Let's start with the unemployment data that came out last Friday. What did you see from that unemployment data that you liked? What didn't you like?
The unemployment data was really interesting. That was a very volatile day for the markets. Bitcoin went down a lot, as it always does. Stock markets went down quite a bit too. But what's interesting in the unemployment data is that it was good. And the markets freaked out anyway. And that was the reason why the markets freaked out. But first, let's talk about the unemployment data. The unemployment rate in USA went from 4.3% in August, well, from, I guess, July. And then the August numbers came down to 4.2%. So unemployment's trending back down, at least in the short term. We'll see what happens over the next few months, obviously, and unemployment data will remain a very key indicator to watch. It's worth keeping in mind that essentially we are just coming now off of historical lows of unemployment, right? And that 4.2 or 4.3% is well below the historical average. Usually you're looking at something between 5 and 6% as being like a normal level of unemployment, okay? So this is one thing to keep in mind here. And I know people are going to start talking, yeah, well, it's not about the actual number. It's about the trend. It's about the speed that we're seeing that happen. And that's true, right? If we see unemployment spike to 5% next month, 6% the month after that, 10% the month after that, we got a real crisis on our hands, but we don't have it yet. That's the key thing to keep in mind. So look, here's what's very interesting is that the estimated jobs were coming in at 160. The US missed at 140. Now, here's the interesting thing. That's still 140,000 new jobs for the U.S. economy. It's not negative. It's not like the U.S. economy lost 200,000 jobs last month. I could see people freaking out about that, man. But no, we're still growing. We're just growing a bit slower right now, which is what, again, is spooking the markets. People are starting to look, it's starting to cool down. We're starting to slow. Is this the beginning of the end? We also did have, and this is probably what really spooked markets, downward revisions of previous job numbers. So the June, July numbers actually were revised lower. Again, still positive, still growing, still around 100,000 plus, but revised down. So the US economy, particularly in the labor markets, showing bits of weakness in particular sectors as well. There's a lot of sectors that are doing quite well, hospitality sectors and stuff like that, whereas manufacturing's not doing that awesome. But I remember seeing a great chart the other day that the US economy is made up of something like 12% manufacturing, but it's a much heavier service industry these days, and that the service industries are actually doing pretty okay. So interesting to look at what's doing well, what's not doing well. And I feel like anytime there are positive numbers, because there's been plenty of positive numbers and plenty of positive things, real freight traffic up, stuff like this, the market doesn't like to talk about that stuff. They're much more interested in the doom corn, right?
So unemployment on the whole it's kind of a mixed message right now. It depends on which way you look at it. Everything seems positive, but there's this fear that maybe the jobs market is cooling off and it might not go our direction. But as you said, right now, everything still seems positive. So no need to panic yet. That's for sure. The other major events coming up, we've got the Trump Harris debate tomorrow, today, if you're listening to this, because we're recording this on Monday, and the Trump Harris debate is on Tuesday. We've also got CPI coming out later this week. And then we've got PPI coming out later this week. And then next week, we have the Fed interest rate decision. Amongst those events, what are you watching for?
Of course, the election is going to be very interesting. Basically, and again, people can vote for whoever they want to. We're talking about policies that are specifically going to affect markets here, right? I know it's complicated. Yada, yada, yada. I get it. Okay. But the policies that are being proposed by Harris, as well as her sort of continued moves against the cryptocurrency industry, probably not going to be great for crypto. Markets aren't going to like it. Broader equity markets aren't going to like a Harris presidency. And with all of her tax proposals and stuff, like whether it happens or not, a lot of stuff probably won't happen. The fact that it's being proposed is problematic. And I would expect the war from the SEC against crypto to continue. And we had the OpenSea ruling recently, and I just thought, man, it'd be so easy for her to shut that down. She's the candidate. All she has to do, pick up the phone, call Gary over at the SEC, say, hey, Gary, would you like me to be my Treasury Secretary one day? Oh, you would? Well, then cut the crap out, man. Stop going after these people who want their money, want their donor money. It's that easy. It's that easy. And if she doesn't have the political savvy to make that kind of deal, how the heck is she going to be a president, man? The flip side is Trump's, of course, packed his team with pro-crypto people, RFK Jr., Tulsi Gabbard, Vivek, JD Vance. These are all pro-crypto people. A lot of them own significant amounts of cryptocurrency. So that's like the pro-crypto team. The Cantor Fitzgerald guy, he's like, big wealth fund manager. He's coming on as an advisor, apparently. So you got a lot of very, very pro-crypto people coming in here. And look, right now, Trump is ahead at most polls, especially in the battleground states. So it's really, I guess, Trump's debate to lose, right? If he screws up somehow or whatever, but he's so practiced. He talks to everybody all the time. So that's going to be a big event for the markets. And I think the markets will continue pricing in, assuming everything goes in Trump's favor during this debate, the potential for a Trump presidency, which generally the markets tend to like. The markets like the idea of a Trump president. Again, I don't care about your opinions about Trump or Harris. That's all fine. You're allowed to think whatever way you want. We're not telling anybody to vote any way here. We're just looking at purely how the markets are reacting to the potential of one candidate or the other. And so I think that's a really big thing to watch out for.
What about CPI, PPI later this week? And then obviously the big Fed interest rate decision next week, September 18th.
Next week, yes. Inflation's a beast that's largely been tamed, hopefully. Look, if inflation starts peaking back up in any significant way, that's problematic for the markets. The Fed's then in a really tough position because they need to cut rates to get the labor market stimulated. But if they start cutting rates and inflation's going back up, it's probably going to mean more inflation. This comes back to the idea that I've been thinking of, that we might even have that sort of Q1 market top, something like this. And I don't know, it's hard to predict that far out hard to predict what's going to happen tomorrow, let alone that far out, right? But once the rate cuts start coming, that could actually bring inflationary forces back into play, which could, let's say, complicate things a little bit. But I would expect that inflation this week will continue to be cool or cooling. So I don't think that's a big issue right now. Even the Fed's come out and said, hey, look, the inflation thing, not that big of a deal currently. So don't worry too much about it. We're focused on labor markets now, which is, of course, the big point to be watching out for, what's going on with the labor markets. So inflation currently not a problem unless it starts trucking back up. But there's been so many deflationary forces right now that I would be surprised to see inflation really popping back off. Oil's down and a lot of other things down. There's certain costs that are going back up, but for the most part, outside of things like orange juice, which has like had the craziest, we should have all invested in orange juice futures, man. We screwed up big time holding Bitcoin. It should have been orange juice futures, the other orange coin, I guess. But outside of some specific products, most prices are coming down on a lot of things. So it's good for the consumer and it's bringing down inflation. And then, of course, the interest rate next week. So it's massive.
Yeah. And I think everybody expects the interest rate to be dropped, whether it's 25 basis points, 50 basis points, unknown. Clearly, so long as it drops, everything's going according to plan. I don't think it matters so much if it drops 25 or 50, as long as it drops. If it didn't drop, that would be a major red alarm for everybody. Let's go on to big news that came out end of last week, is that global money supply has hit all-time highs. What is leading global liquidity to be rising to all-time highs right now? And what do you think that will lead to in terms of impact moving forward on the markets?
Global liquidity, the tide that lifts all boats. Right now, we're seeing a lot of different things in terms of global liquidity, but in terms of the global liquidity index keeps rising as we see more and more central banks cutting interest rates around the world. Money becomes easier to get for companies and people and stuff like that. The U.S. is kind of a lagger when it comes to cutting interest rates. Quite a few other banks have already started doing that. The Reserve Bank of New Zealand, for example, did it 2 weeks ago. I think they cut their interest rates. We've already seen multiple cuts in other major places. ECB started cutting a few months ago. So it's already kind of happening. Money's getting a bit easier right now. We did have an announcement recently. I think China's injecting another $420 billion into its, let's say, lagging economy right now. Chinese stocks are crushed. Chinese real estate's crushed, right? But the Chinese economy remains one of the most important economies in the world, of course. And to an extent, I've even seen theories that the whole conversation right now shouldn't really be about a U.S. recession problem. The U.S. was doing okay for all intents and purposes. Not the best roaring economy in the world, but it's fine. It's cruising along. It's treading water. But the real problem is in China. And China is going through a bit of a crisis right now on multiple fronts. And that's where the liquidity is really being pumped in right now. But there's all kinds of liquidity injections surreptitiously happening in the background, whether it's more direct from the Bank of China, drop it in, almost $500 billion, or if you see stuff like what's going on at the Fed right now, or actually the Treasury is doing a $50 billion bond buyback. I think in the month of September, they're supposed to do like 15 billion. Next month, they're doing like 35 billion or something like that. So it's 50 billion in total, but a lot of money sloshing around the system out there. And as more money enters the system, more liquidity enters the system, it tends to be good for risk assets, aka Bitcoin and the rest of your crypto coins. Okay, so that's the main point of liquidity, is that it will be the tide that lifts all boats.
And the other thing that's coming is Q4 is coming. I mean, obviously, time keeps moving forward. But I say that because Q4 is often a period that has an impact on markets. Why is Q4 seasonality such a big deal that people are predicting could impact markets forward?
Q4 is really interesting, and it's fascinating to see how seasonality works out. And you start thinking about the reasons behind seasonality, and it kind of starts to make sense. Like the first week of August tends to be the worst week in markets of the year. And why is that the case? Could it be that everybody, all the big Wall Street dudes and all the investors and stuff, they're all sitting on the Amalfi Coast, they're not dialing in 24/7 looking at the charts? Probably, right? Markets are just more susceptible to news. There's less liquidity, there's a little less interest. People are just not paying as much attention during that time. September tends to be a bad month as well. People come back, they start repositioning, catching up on the news, whatever. Things don't happen as fast as you think they would. But then October comes, right? We talk about September as usually being Rectember and October as being Uptober. So look, Q4's got a lot of great seasonality for a variety of reasons. The weather starts turning in the Northern Hemisphere. What else are people going to do? Are you going to go out for a walk? No, you're going to stay in and trade crypto coins, man. That's what you're going to do. It's raining outside. It's cold. Come on. Let's go. Let's trade some coins. So you get a bit of this effect as well. Just the simple reality that 90% of the world's population lives in the Northern Hemisphere. And there are going to be a lot of people up in those regions who are now off the beach and back in the office and doing stuff, right? And paying attention to markets. It's kind of simplistic, but it kind of makes sense. We also have a few other bits of wind in the sail for our talk here on seasonality, because everything's happening in Q4 this year. Rate cuts are coming in September. Okay. So that doesn't have like day one, like massive impact. It takes a while for the reality of rate cuts to sort their way through the economy, but the markets will probably like it straight away. And that sets us up. I mean, it's happening December 18th, right? Almost Q4, a week away. So that sets us up for smooth sailing. Well, let's say wind in the sails, not necessarily smooth sailing for Q4. I'm sure we'll have plenty of volatility with everything going on. Generally speaking, as long as we get rate cuts outside of a recession, and there is no recession in the USA right now, it's unlikely to happen in the next 8 days, okay, guys, then it's usually a bullish event for markets, okay? There's so many things not pricing in a recession right now. We can still have something break and recession comes sooner than a lot of people expect, but it's probably not going to happen in the next 8 days, which means that we're probably going to get some positive force from the rate cuts when they come in, which speaks well for the end of the year, the Q4 narrative. We have the elections coming in Q4. Again, if we see Trump taking the crown here, then market's probably going to like that going into the end of November and into December. So there's a lot of things here working in the favor of the potential for a big Q4 rally this year. Of course, nothing's certain, guys. We only talk about our models, what has worked in the past, what could work this time around. Markets are chaos, as we all know, and any little tiny event could derail all of this at any time. So we're optimistic, but maintaining a little bit of caution in the background.
When we talked earlier about the soft landing, which seems to be the term that is most used on crypto Twitter right now, everyone's talking about the soft landing, not just crypto Twitter, the entire equities, all asset markets are talking about the soft landing. And will it happen? How do we know if the soft landing happens or not?
Soft landing happens if the US doesn't get a recession. Basically, the hard landing is the recession, right? The soft landing is the cooling, bringing the inflation back down and the stuff without it making trigger a recession. Now, recessions happen. They're a normal part of the business cycle, et cetera, et cetera. And we might see a recession a year or something from now, not necessarily related to this specific thing, which means the Fed pulled off on its end what they claim to be the soft landing, and then something else breaks, credit markets or gosh knows what. Who knows, right? But that's basically the main idea here, is that we're going to be able to pull off all this, that the inflation has come down, which the Fed has done. The Fed has managed to get inflation down, and they've so far done it without breaking the labor market. Now, the labor market's showing signs of softening. The labor market's showing signs of stress, but it's not broken yet, which of course puts key pressure on the Fed to cut the damn interest rates already, man. And they probably need to cut significantly by the end of the year. The worry now is that the Fed's not going to do enough soon enough, and that it's not going to have enough of an impact. Because let's keep it real, guys. A 25 basis point cut's not going to really help all that many people out all that much, right? It's, oh, your interest rate just went down by 0.25%. Thanks a lot. Great. We're going to need more. And so where do we end up with interest rate cuts by Q1 next year? We could be down to 4% or something like that, or 3.5%. It's hard to say how we're going to go. And I'm sure the Fed's going to continue to update us on where they see the economy going as we go through the process. But if we get down to 3.5% to 4%, that becomes much more manageable for businesses, for real estate speculators, all this kind of stuff. The current rates are just like that little bit too high that just puts too much pressure on companies and stuff like this, which moves us closer to a very weak labor market. It's weakening. Not the weakest it could be, far from it, in fact, but we're trending in the wrong direction, which is what continues to worry the markets.
Mm-hmm. So we've got a bit of a wait and see moment right now. Wait and see what happens over the next few weeks. I hate to say it because I feel like we've been saying wait and see for a few months, but as you said, seasonality, here we are. Every year this happens, and we're back in this position again. But unlike the last few years, this year, everything is lining up for what is looking like a good Q4, which is why we're feeling good. We'll keep you guys updated on all these things, the debate, what comes out of that, the CPI later this week, and of course, the Fed announcement next week, and so much more. Thanks so much for tuning in, everybody. We'll see you next week with Lark, and we'll see you tomorrow. We got Kyle back on the show. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.